bit on how you can really begin to scale from a technology perspective, raising capital from IRA investors, and much of that is due in part with the Sponsor Cloud software. Let me go back to number one for a moment. I'll give you a quick use case or case study. I'm working with a deal sponsor right now. I've actually been working with them for about 3 to 4 years. And over the last 6 to 7 months, so since the beginning of this year, they have raised capital from 474, to this date, 474 IRA investors. Millions of dollars in capital that they've been able to raise specifically from self-directed IRA investors. These were all folks that they marketed to. These were folks that opened new self-directed IRAs with equity trust and then used that money to deploy that capital into investments. Now, they've been very successful in doing a lot of this on their own and then in concert with us from an operational perspective. But I'll share with you that here's where we can potentially make an impact together, and that brain sharing thing comes into play. So 2 weeks ago, they invited me on to one of their IRA Q&A webinars. So they called me up and said, "Hey, John," and it was a little bit short notice, but they said, "Hey, can you jump on this online? It's going to be a live call. It's an IRA Q&A webinar." And I said, "Sure, I'll jump on." They said, "We just kind of need you on the wings to answer any maybe more technical related IRA questions." And so I jumped on this call, and quite frankly, I sort of expected that I wasn't going to say much. If there was a technical related question, I would answer the question. That's what I do. That's my expertise. My core competency and sort of genius zone is everything related to IRAs. And so I jumped on the call, and it turned into an hour and a half Q&A session all about how to move money over from point A to point B, requirement of distributions, how to invest in a real estate syndication, how to invest in a real estate investment trust. So it was mostly, I'd say 45 to an hour, all questions related specifically to equity trust, IRA custodial work, how it works, how to move money over, and most importantly, demystify a lot of the myths that are going on in the retirement plan industry, some of which are perpetrated by financial advisors and other financial professionals that don't have the monetary incentive to tell their clients about investments in real estate. And after the webinar was concluded, they had a number of inquiries. There were close to 300 people on this call. They had a number of inquiries from IRA investors. The IRA capital raising within the last couple weeks is 4x what it typically is on a weekly basis. So call it a 400% increase in IRA business from that Q&A webinar. And so I tell that story because if you're integrating self-directed IRA education and telling the story the right way, you can really make a major impact. And if you're leveraging some of the resources and tools that we have to offer, you can really make a very large impact. All right, last but not least, this last one is really, really important. I want you to be very attentive to this. Attempting to rely on the so-called low-hanging fruit of current self-directed IRA firms, it doesn't work, okay? Who has thought in this room, and it's okay if you did, if you don't want to raise your hand, you don't have to, who has thought, hey, there's about 100 self-directed IRA custodians and administrators out there. I'm just going to call every single one of them and try to put a pitch deck in front of them and try to do a webinar with their clients. All right, there's a few, all right? And for those of you may not want to admit to it, and if you don't, that's okay. And for those of you that are already thinking like, hey, it makes logical sense that I would just call every IRA custodian and administrator out there and I would try to put a pitch deck in front of them. Here's the problem with that. There's actually 2 issues with that. The first issue is you'll learn that custodians, self-directed IRA custodians and administrators, equity trust, just like all the others out there, we are bound by very specific regulatory guidelines. So for example, equity trust, our primary regulator is the South Dakota Division of Banking. We are a directed custodian, which means the client provides direction to us. We don't advise, recommend, endorse, all of the things that I mentioned on that disclaimer slide. So with these rules and guidelines, it's very rare for an investment sponsor to be able to pitch deals to self-directed IRA custodial clients. Now, you will see it occur in some forums, very controlled and monitored forums, but it takes a significant undertaking in order to do that. Now, I will let you know that if you call enough custodians or administrators, you're gonna find somebody that will allow you to come into a webinar or some other type of forum. Or I've also heard of some firms doing kind of like networking, sort of networking events. It might be effective for you. Here's what I'll caution you with. This is what I've learned in my experience over the last 15 years. You'll get somebody from one of those custodians on the phone that's in business development. Most of them, I'm just gonna speak bluntly, have worked in the self-directed IRA industry for less than a year. They're paid on commission to bring clients in. So the moment you tell them, oh, hey, I could send you clients with IRAs, and then in reciprocation, we'll do a webinar together. And then you spend all this time, energy, and effort putting together a webinar, putting together a deck, making it go through compliance. You have 17 emails back and forth on why this word can't be used, but that word's okay. And then you get on the webinar, and there's 10 people on the webinar, and you sell nothing. Mm-hmm. Has anyone by any chance experienced that before? Anybody experienced that? At least one person has experienced that. I can almost guarantee that's going to be the experience. However, if you approach it in a slightly different way, if you tell the narrative right from the very beginning, and you bring the custodian in at the right position and at the right time, you're going to be that much more effective. The story I just told you a few moments ago about the deal sponsor that's brought in over 400 accounts, okay, they start their marketing on the deal and the opportunity. They bring in the IRA at the right time, and then in the middle of the funnel, they're bringing in the custodian. If you bring in the custodian too early, you're likely going to set yourself up for failure. All right, so make sure that you remember those 3 items. We don't want anybody falling into those traps or pitfalls. Now, again, I'm going to show you some solutions to these. The first thing that I want to share with you is really how to tell the narrative on investing in real estate and other private market investments. So remember when I said eradicate the term alternative investing? Well, what term should you use? The term you want to use is private market investing. Private market investing. Very important that you use that term. Also, as a marketer, I've gotten to understand, I'm not a master of this, but I've gotten to understand, mostly because my wife works in the business as well. She's been in the business for 17 years, and she works in our marketing arena. She's a data analyst. And so what she tells me is, hey, John, from an SEO perspective, from an online digital marketing perspective, private market investing is what you want to use, not alternative investing. Because remember, the consumer investor behavior is that alternative is bad. But private market investing looks very good in the digital arena. All right, so that's a very important tip to take away. The public markets versus the private markets. Let's pause there for a moment. Do you think you would be successful right now, as it stands today, if you look at the public markets, do you think you would be successful in going out and telling people that, oh, hey, the stock market's doing bad, you need to invest in real estate? Do you think that's going to work? It's not. It is absolutely not going to work. I'll tell you a quick story on that. In 2021, the stock market was doing pretty well, right? Things were fueled, on fire. Stock market's doing well. I'm at family parties, and my uncle, my brother, my father, they're all making fun of me at the party because I own real estate in my self-directed IRA. In fact, in 2020, I had bought a single-family rental property from a motivated seller for $63,000 in Cleveland, Ohio. Had $15,000 in deferred maintenance I needed to put into the property. I knew it would appreciate anywhere between 115 to 120, and I could sell it to an out-of-state buyer. They looked at me like I was absolutely insane. Who else is there? Have you ever had somebody that's looked at you like you're insane for buying real estate, investing in real estate, right? And so my family, you know, they're mocking me for owning real estate in a retirement account. And they're saying, oh, my financial advisor's been doing great for me. I'm up X amount of percent and everything's going well. And then 2022 comes around. 2022 comes around, interest rates start rising, right? All of a sudden there's economic and geopolitical turbulence. And what happens to many Americans' retirement portfolios? It's right here. Fidelity reports, it's a CNBC article, retirees lost 23% of their 401k savings in 2022 compared to 2021. So in 2022, all of a sudden I start getting calls from those same uncles, my brother, my father, asking me, John, what do we do? My portfolio's down 20%. Should I sell? What do I do? What are you doing? I said, I'm not really worried about it because most of my holdings are in real estate. While everybody was losing money, I sold that property and made a 32% cash-on-cash return. I was also lending money secured by real estate and making returns that way as well. I wasn't worried about it. And so the point here, again, consumer investor behavior. Right now, things are good, right? Now, I don't have a crystal ball, nor does anybody in this room. Is the market going to continue to go up? Is it going to go down? I don't have the answer to that. But the narrative here, I believe, is telling the story like this. Here's what's happened in the past. I'm not saying that's going to happen in the future, but it's something you should consider in order to bulletproof your retirement savings account. That's another term you could write down. Bulletproof your retirement savings account. From a marketing perspective, that's another one of those terms that's highly impactful. Now, I know for many of us in this room, you're thinking, wow, bulletproof, I don't know about that. Again, consumer investor behavior. Sometimes it defies all logic. I have down here, it says most prospective investors, I know it's hard for some of you to read, it says most prospective investors don't know or financial professional has no incentive to inform. All right, this is an important one to touch on. You are most likely, when you're raising capital from IRA investors, you are going to face extraordinary opposition from a client's financial advisor or other licensed professional. Who has already faced that type of opposition? Okay, a few of us. If you haven't, you will inevitably face that opposition. I have faced that opposition many times. What I will tell you is the strategy is not beat up on the financial advisor or financial planner. That is the wrong way to approach it. You're going to want to make sure you write these down. Creating an adversarial relationship with the client's financial advisor is not going to work. It is not going to be effective. Mm-hmm. In my experience in working with thousands of individual consumer investors, oftentimes their financial advisors and financial professionals are who? Friends, family, people they go to church with. Those are who their financial advisors are. I've even had people say, well, John, I really like the idea of owning real estate in my retirement account. I really like the idea of private money lending. I really like the idea of investing in this multifamily real estate project because I know that the returns are substantial. But you know what? Jimmy's been a family friend for 25 years, and I went to school with his son, and I don't know about taking money away from him. It's an emotional decision for a lot of consumer investors, not a logical decision, right? Creating an adversarial relationship is not wise. What you want to do is team up with the client and their financial advisor. Surprisingly, there are a lot of financial advisors out there that are actually open to alternative, I did it, private market investments. Good, someone stop me. All right, we're paying attention. Private market investments. Some advisors, they can't sell away from the firm, right? We have to educate clients on the fact that financial advisors oftentimes cannot sell away from their firm. Meaning if the advisor got involved, even talked about in an email about real estate investing, they're going to get in trouble. And I know this, I'm not going to mention the company specifically, but I know a financial advisor that he was referencing real estate investing in one of his emails. In the compliance department, they review emails. In financial services, they do that. They spot check. And he said, hey, why are you talking about real estate in this email? He said, well, because the client wants to invest in real estate. Isn't it my job, my fiduciary responsibility to do what's in the best interest of the client? No, you're not allowed to talk about real estate. Does this add up to anybody? Does that make sense?
Nope.
So they have a fiduciary responsibility, yet they can't talk about these types of things. I never understood that. I doubt I ever will, but that's just essentially the way that people are playing the game. And then I just figure out how to play by a little different rules. The right rules, the appropriate rules, right? But a little different rules. And so you have to be mindful of this. And what I would encourage you to do is educate the investor on the opportunity, educate them on a self-directed IRA. And maybe that doesn't mean that they're taking all the money away from the financial advisor. Maybe they're just allocating a percentage of their portfolio. And then that financial advisor is going to be that much more open to having the conversation around real estate or other private market deals in that retirement account. I've been able to get many financial advisors to that point of understanding. In fact, if you go on our YouTube page, one shameless plug, if you go to YouTube, you search Equity Trust, you're going to find a ton of videos. All right, they're educational in nature. We're not pitching things. They're not hypey. We're not driving around in sports cars. All right, that's not what our channel is designed for. What you're going to find is a video on there that says, share this with your financial advisor or CPA. And what I'm doing is I'm educating investors and I'm educating their financial advisors and CPAs on what a self-directed IRA is. And then, of course, what it's not. So you can check that out as well. I'll include my email address at the end, by the way. And if you guys want to use some of these images and use some of this content in your marketing and your pitch decks, you're more than welcome to do that. That's why I put these together for you, so that you can start to build the right narrative. You'll notice I keep saying that, building the right narrative. That's very, very important. All right, here's another one for you that you can include in your pitch decks. Private market investing. This is from the Bank, Housing, and Urban Affairs. This is actually directly from a piece of legislation that was being proposed last year at the end of the year by Patrick Toomey and some others. It was called the Retirement Savings Modernization Act. And it didn't go through. They're still working on these types of pieces of legislation. But here's what I want to point out for you. They reference specifically a Georgetown University study. And I'm going to read this for those that can't read it all the way in the back. Until the 1970s, most Americans working in the private sector relied on pension plans for retirement. Today, however, the vast majority of private sector workers rely on 401k plans. In 2019, 85.5 million Americans participated in defined contribution plans such as 401k plans, while only 12.6 million Americans participated in private pension plans. However, pension plans have consistently outperformed 401k plans because they diversify across a full range of asset classes, putting one of every $5 in alternative asset classes like private equity. One out of every $5. That's 20% allocation to alternative investments. A recent Georgetown study estimated that 401k plans diversified with a modest allocation to alternative asset classes, private equity, hedge funds, and real estate. It says real estate. No, there's a lot of real estate syndications there. Would increase American workers' retirement savings by 17% per year and reduce losses in a downturn. So the pensions, the endowments, the sovereign wealth funds, the family offices have been investing in alternative assets, specifically real estate, for a lot of years. Yet the everyday investor hasn't had access to these opportunities. Who can get them access to these opportunities? You can get them access to these opportunities, right? And so you start telling this narrative. And now, what do you think people are thinking when you start giving these stats, right? When you show them this, right? And then you show them this. And let's fast forward another moment and let's show them this. This is also from Georgetown University. A major concern with DC plans. That's for those that might be going in screensaver mode. Very quickly, defined contribution stands for 401k. Major concern with DC plans today is the volatility of underlying accounts, which are invested primarily in a mix of stocks, bonds, and cash. Because plan participants fully absorb the gains and losses of their accounts, market events can drastically impact their ability to retire. Consider, for example, A worker ready to retire in early 2008 with $500,000 saved in her account with 50% allocated to equities, 50% allocated to bonds. Right? Remember I talked about the 60-40 model? Well, the 60-40 model is generally when folks are a little bit younger. As they get older, what do? They shift more of their allocation to fixed income. 50-50 model, between January 2008, so this was the great financial crisis, right? 2008 and March 2009, global equities lost 41.1%, while their value in U.S. bonds gained 4.3%. In that environment, this worker who was nearing retirement and thought she was invested appropriately would have lost 18% of her balance. Now, I get that was in 2008, but some of the folks that you're speaking to would have went through that financial crisis, right? And let's face it, a lot of people have already forgotten about that. And I believe we need to remind people of that pain and suffering that we all went through back in 2008 and 2009. Now, I was very fortunate because that's when I came into this alternative private market investing business with IRAs. And a lot of people were displaced from their careers and they had 401ks that they finally gained access to, and they were able to use that money to invest in real estate and other alternative assets. So I'll say that I may not have been as impacted as drastically, but I saw a lot of people impacted in a very significant way. So this worker, her account from $500,000 is now $410,000. Now I want to share something with you that might be, well, definitely is elementary to everybody in this room. All right, but it's not elementary to the consumer investor, right? Again, that's that the consumer investor thinks differently than we do. So here's an exercise that you can take them through in your marketing. If I start with $100,000 in an IRA or retirement account balance, and I take an 18% loss, so I'm just pulling that directly from this source. I always want to make sure I'm very factual in citing these things. I'm not just speaking in hyperboles. So I got an $18,000 loss, which brings my balance down to $82,000. So oftentimes when I speak to consumer investors, I'll ask them, I'll say, how much do you need to make? What does your return on investment need to be in order to get back to your initial balance? And usually they're going to say 18%, right? But it's not, right? We do the quick math, and it's 22%, 4 percentage points higher. So they got to make a that much greater return. Not to mention the opportunity cost, right, of what they could have been doing with those additional gains. That's the whole point when you run the analysis. That's the whole point of the pensions, the endowments, the sovereign wealth funds. That's why they invest in alternatives. Because when there are hiccups in the traditional markets, they're able to make up for that. And then, of course, alternative investments, there we go, I did it again, right? Somebody's got to correct me every time I say alternative investing. Right. Private market investments. Investing in private market deals, although you give up liquidity, generally giving up liquidity, you're going to get back what? Higher returns. Right, that's the point. And that's the story you have to tell. Now that's an important point, let me pause on. Why am I telling somebody at the very beginning that their investment is going to be illiquid?
So they don't put it all in one basket. You don't put all your eggs in one basket.
One is because, so they don't put it all in one basket. I want to make sure that they view me as being honest, right? I want to explain to them the objectives of that. It's an illiquid investment. And then I'm coming right behind with that, explaining the opportunity for the return. What I'm doing is I'm overcoming the objection from the very beginning, right? Because that objection is going to come up. Who do you think is going to bring up that objection? The financial advisor or financial salesperson, right? They're going to bring that up. They're going to bring up the fact that it's illiquid. Oh, what are you going to do about required minimum distributions? That's always been the biggest one that I've gotten over the years. Well, what about required minimum distributions? And I'm talking to a 40-year-old. Does anyone know when required minimum distributions for tax-deferred accounts start? They start at 73 years of age now. And you'd be surprised how many traditional advisors will bring that up just to create a roadblock so that person won't move their money and invest in the private market deals that you're offering. All right, last slide. Again, you'll have these. Private market investing. This is from Statista.com. There's a lot of other sources. KKR, which is the biggest private equity firms on Wall Street. They also report a similar figure. the allocation of high net worth individual investors to alternatives is 26%. Now, I'm not suggesting that you put 26% of your portfolio into alternatives. I'm not suggesting that every investor that you work with puts 26% of their retirement portfolio into alternatives. I'm just showing you this so that you can paint the picture of this is what high net worth individual investors are doing. High net worth being people that have $1 million to $30 million in investable assets. And then when we look at ultra high net worth, which is 30 million and up, and then you start getting into the family offices, they're at a 50% allocation reported by this same study into alternative investments. So this brings up the question that you can ask your investors. And you don't have to answer it for them, just ask them. It's sort of a rhetorical question, right? So let me think about this. The pensions, the endowments, the sovereign wealth funds, the family offices, the multifamily offices have been investing in alternative assets for a lot of years. I mean, we're talking hundreds of years now. So why doesn't the everyday investor have access to these types of opportunities? Why doesn't the everyday investor have access to these types of opportunities?
Liquidity.
So you ask that question, right? And now you become a solution provider, right? You have the alternative investment opportunity that you can provide to them, that you can offer them. Okay, so again, those are the slides that you can utilize to start to tell the story. In conclusion to this segment, you want to start with teasing out, right, why private market investing can be important to an overall portfolio. And when I say portfolio, I'm talking about portfolio design, not just 60-40, but maybe it's